Welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast. I'm one of your hosts, AJ Wheeler. With me, as always, is Mark Hallerty.
Hey, everyone.
Got a great show for you. We have a couple articles here. What donors can learn from succession planning in business. Why succession planning is good in your nonprofit, and donor succession planning. What are the ins and outs of large donors that want to, see their gift work long after they're dead? We'll talk about the pitfalls, what we think about that. And then our next article is from our friends over at the SSIR, the Stanford Social Innovation Review, and it's how impact data changes the way donors give. We've talked many times on this podcast about how important, metrics are, or qualitative and quantitative metrics of what your nonprofit does can, help you. This actually puts a study behind that and gives us real numbers that it actually does work. We'll talk about how they did the study, kind of what it entailed, and what the outcome is. And then our last article is soothing nonprofit turnover transitions. So we talk a little bit about succession planning from a donor side. What about succession planning in your nonprofit? How and why it's important, and some personal stories from us on why you should do it and think about it sooner rather than later. And then our last question of the week is, should you take a donation of a timeshare? Oh, good old timeshares. We'll get into whether your nonprofit should even think about taking one of these things on, and why it may not be the best idea for your nonprofit. But Mark, you got our first article for us. Take it away.
Hey, thanks, AJ. Yeah, our first article today is from Philanthropy Daily, and it's called "What Donors Can Learn from Succession Planning in Business." So the main premise, this is a pretty short article, but it's an interesting thing to think about in accounting circles. From a donor perspective. So what do you do if you have a foundation or you have a donor who has a lot of money that is going to last beyond their lifetime, maybe an endowment, maybe some other foundational work, and they have intent of what they want to do with that money. But once they're passed, how does that donor intent get protected? After their death, how do we protect the original donor's wishes, right? And so there's a few different ways that foundations and other philanthropists do it. They can have a time approached method of giving, so that they have specific things set up to fund after their death, as opposed to an organization operating in perpetuity. They might also choose somebody who isn't necessarily in their family, because the problem is oftentimes the people who you have inheriting your foundation or who are taking on the legacy are often people in your family, and they might not align with what you believe in. So if you have a specific wish for your foundation and you know like-minded people, then you might want to figure out inheritance for your relatives separately from the transition of the foundation. And if you can do that successfully and you find a group that matches with your wishes, then you can kind of have a neutral third party arbiter or overseer. But again, you're still not guaranteed, because if you're turning those foundation funds over, even if you have it kind of codified in your mission and vision, what you're doing with the funds, once the money is out there and you have a new executive director or you take a new tack, then maybe the mission changes, or life changes, history changes the world, and people start to think about things differently. So, I have some reservations about this article and some of the suggestions they make. I'm gonna throw it to AJ and kind of get his ideas behind this, and then we can bounce back and I'll cover a little bit more. But it is something to think about, especially if you are working in the foundational sphere and you still have some legacy donors there who want their wishes preserved in perpetuity. So, AJ, what do you think?
When I read this article, I was like, wow, this is really skewed towards a donor's kind of almost like self-centric kind of attitude towards how they're giving money. What the article doesn't contend with is there's a push-pull here between a donor and a nonprofit, where the donor may want their money earmarked for something, and that absolutely can happen. And the article doesn't really get into what type of gifts they're talking about so much, like an endowment, where you presumably give a nonprofit a large amount of money. The intent behind that endowment is to have it as an investment vehicle that you spend the earnings off of. And usually for operational purposes, I mean, you can intend it, and restrict it for a program, say the earnings for a specific program. But realistically, even an endowment can be, the principal can be spent down if needed by the nonprofit for that purpose, under the UMIFTA laws, and then, either re-upped, or it just is what it is after that. A restricted grant coming in, or a restricted donation to fund something, needs to be, I mean, you can make that restriction in the documents and all that, and the nonprofit must hold true to that. But it's on the part of the donor to follow up and make sure that the funds were spent as expected. So there's a lot of like intermingling between a donor and a nonprofit, especially large donations to a nonprofit, to be able to make sure that the wish of the donor is carried through. And they're talking about generational, a gift that spans generations here after somebody has passed. And I would say, the original donor or the original donation document needs to be looked at and crafted in such a way that it carries on, the donor's intent behind it. But then what happens if, say, you give an endowment that is supposed to fund a specific project, and that project or the mission of that nonprofit kind of switches gears, like Mark was talking about, over the years, and moves away from, say, early child development to, preschool funding or something for underserved kids. You want to make sure that the nonprofit isn't, if you're in the nonprofit, that you're not going against the donor's wishes, or to go back to those donors and ask, if those funds can be used for a similar type project that you're moving away from what the original intent was, but be able to convince them and get it in writing. I think the real thing here is, they're really putting a high value on what the donor intent is. But we've talked about on this podcast before that nobody knows how to run a nonprofit better than a nonprofit, or nobody, I would be very surprised if a donor has better boots on the ground knowledge of what's needed in a community than the nonprofit that has, people in that community, serving that community and understanding what it is. So I would say, although I think this is, something to think about when you're making a major donation or a major type of gift. I think, allowing that nonprofit to thrive and use the money as it sees fit is probably, again, it's a push-pull, right? You want to make sure that your money is being used wisely and for good cause. But then do you really want to be in the weeds about how it's being used, and even in the weeds about how it's being used for generations? I would almost say that that's kind of, the I guess the golden ticket here, or what we're really trying to get at is how you can manage both, from a programmatic standpoint and from a donor standpoint, of how does that push-pull kind of relationship work, and how do you keep donor intent and, let them know that their money's doing good versus, and we'll talk later in the podcast about how that can be done and actually increase your donations. But and then from a nonprofit's point of view, you're not handcuffed with so many restrictions on the money that came in that it's very difficult to provide to your constituents that you're serving. So, but Mark, I'd love your take on this.
Yeah, I'm going to be a little stronger than you are, because, boo-hoo-hoo, this was put forth by this study was put forth by the Rockefeller Philanthropy Advisors. So right there, you can see some of the big heavy names that are in and are invested in having the original donor intent. You could see some other big names, J. Paul Getty, whatever, some of these other, Carnegie Mellon Foundation, etc. A lot of these original donors were alive decades ago, if not hundreds of years ago, and they made the wealth. And so they're now trying to give back, which is great. But if their wishes were kept in place, society changes, the world changes, right? if I become some mega billionaire and I determine what is good for me, and I want to decide for perpetuity what is good for society, situations change. I mean, I think an example, maybe a straw man that I can put here is the Ford Foundation, right? Henry Ford, a known racist, right? If he had put in his Ford Foundation after his death that all the monies and all the stuff that he was wanting to support with the Ford Foundation had to go to people of his race, people would have a huge problem with that. But if that's what his donor restriction is, we have to just kind of roll over and go, okay, Henry Ford, that's what you want to do. So, of course, the Ford Foundation is now known as a great philanthropical organization that gives to lots of causes, including racial equity causes. And that's a good thing, right? The original donor intent had to evolve, and it may still be helping the poor or helping whatever in generic categories, but it can evolve. And I think having super wealthy donors boo-hoo about what might happen to their money after they're dead just seems really tone deaf to me. If nothing else. I don't know. That's kind of how I feel.
No, I think it's a good point. I think, like it's ever changing. And for generation, if you're talking about generational gifts, it's really difficult, I guess, to also to discern what that original intent is. If somebody wrote like a donor document 100 years ago, what was their real donor intent?
Right. I want to support the horse and buggy industry forevermore, right? And it doesn't even exist anymore, right? So, go with the times. And frankly, what happens with my money after I die, I don't give a shit. Sorry.
Well,
I'll keep it
dead,
PG.
so you can't really
right.
you can't really make it. Even if you cared, you couldn't make it.
Right. Anyway, AJ, I think you got our second article.
Sure. So this is from our favorite publication, Stanford Social Innovation Review, SSSIR. And the title of the article is How Impact Data Changes the Way Donor Gives. This is something that we've talked about on the show before as like a good practice or best practice in the industry, is to be able to have reliable metrics on who you serve, how many people you serve, the impact you have. And we've always anecdotally known that really does good for the nonprofit. It's easy to report on. It's easy to put into a kind of annual report of what you've done. So this is actually almost like a research study that was done at Stanford, and they had a theory that essentially these metrics, do they matter? And the theory is that it does, or the hypothesis that they put forward is it absolutely does. So what they did is they went around over the past 8 years, they did a publicly funded research initiative and essentially like objective impact metrics for all nonprofits. And they collected metrics on thousands of charities and consolidated them into a nonprofit registry. And those metrics included information that had the specific outcome that the charity aims to achieve, the number of beneficiaries, whether the program operates in a high need area, cost of producing a single outcome, quality of impact evidence. So they got all this information together, and then they partnered with a couple funding foundations and essentially to test whether the availability of these types of metrics and a better choice led to an influence on giving behavior. So they go through we'll link the article. You can go through and understand how they did this rigorous scientific testing and what their kind of test pool was. But nuts and bolts of it is that it really does make a difference. We'll cut to the chase here. And donors made different giving decisions based on what they were presented with. So differential performance on metrics influence who gets the donations. This mattered a lot. So if you can present a side-by-side and a clear winner, essentially saying we can, with this amount of money, we can serve this many people in this affected area, that awards, grants, and everything else, donations came in much more. It was a huge winner. Then they asked the question if the metrics increased the size of the donation. And it's interesting, the results were inconclusive. So I think, like really what they're getting at here, and then the last one, sorry, do donors care about using metrics to compare charities? And it actually says yes, they do. And I think this is a really interesting part of the study where we're moving more away from that charity navigator scoring kind of card to if somebody has more robust information about who's being served, how they're being served, and how their money is being spent, that is a better deciding factor. And about 75% of the respondents agreed with that. So it gets into why it matters if you're a donor, but the bottom line of it is to be able to provide data so that all donors can more effectively invest in a social change or in a nonprofit that does something. And the study showed that it's easier to compare giving options, and giving people access to the data really changes the way they give. And it makes it possible for donors to use their resources better, to give to effective charities and make a bigger impact. So I thought it was a neat article to kind of put some substance behind what we've been saying on this podcast for a while, that these metrics matter, and having them and investing in a system to be able to provide them not only makes, of course, reporting easier to your grantors or donors on how their money has been spent and what's been effective for them, but it actually makes a big difference about how you're getting money in the front door. And so thought it was a really interesting article. Mark, I'd love your input on what you thought about the article and what you took away from it.
Yeah, I think this is a great study, and I think it's kind of one of those studies where you read the results and you're like, well, of course, duh, right? Because people like metrics, and finding out that the charity you're giving to is actually having tangible results and measurable results is going to work for some people. And I know we've talked many times on the podcast about fundraising pitches, right? And often the new language is kind of give these anecdotes and make people feel like part of the story, and kind of do the touchy-feely, like get people emotionally involved and invested in your nonprofit, which is great advice. But at the same time, there is a segment of the population, I as an accountant count myself as one, that doesn't want to necessarily be pandered to by just emotional heartstring kind of stuff. And having accessible, comparable, measurable, objective metrics like, this is what we did with your money, this is how many people we helped serve, this is what we can do in the community. And even for new programs, if you give us more money to help fund this new program, we anticipate being able to help these many more people, or we'll have this percentage impact. Percentages are a little squirrely because some people can't wrap their heads around it, but real life metrics really do make a difference. And the study was interesting. I mean, I think they called it the choice matrix or something like that, because they gave the study participants the option to choose, like, here side by side you have, and they're not telling them exactly what they're doing, but you have a charity that just, it has an emotional appeal, and then side by side you have a charity that actually has an emotional appeal, plus it gives you some data as to how many people they're helping. And pretty much every time people are going for the ones that have the metrics attached to it, right? Because of course you're going to reach more people that way. You can feel that there are definitely going to be people, especially people who amass great amounts of wealth, that like metrics, like looking at the dollar figures and seeing that their money is going to have an impact. So I totally agree with you, AJ. I think this is a great study. And if your nonprofit out there hasn't quite come to that conclusion yet, consider it. Consider, like, how can I measure this? And how would you do that? I think some of the appeals are good. Some of your fundraising appeals are good, but I really like the idea of an annual report, which we've talked about also a number of times, where you can actually talk about all the good work you've done over the past year and put it in some terms that are metrics related. So that's my take.
Yeah, that's, I think, great points, Mark. And I think, for our development folks out there, I think often, I think a development job is often either misunderstood or pigeonholed into asking for money all the time. And really the impact of a development department is shaped around how the messaging gets out to those donors. Of course, it is asking for money and grant writing and all of that stuff that I think development departments are so often stereotyped as, looking for, new donors, bigger donations, bigger grants, more grants, all that. But I think what this really puts forward is that those metrics that those development departments accumulate, needs to be not just, a financial, how much money from went to admin versus programs, or, just the number of people affected. I think if you have a good, strong, data collection or data on who you served, how many people you have served, and how you served them, I think, you can craft better grant applications by having these kind of metrics in here. And your grant funders are going to really look at your application much better. You're going to have a donor deck or a donor kind of metrics that you can go forward with and show potential donors how that works. Can help in the end of life gift planning, or the bequest planning that so many nonprofits want. You can show them how money is going to be used and how efficient it'll be. And so I think, having these kind of metrics in place, and a lot of different types, who's been served, how many have been served, what was served, which population has been affected the most, and you're funneling resources to. So I think, all those things combined give you a real tool belt full of good things to move back and forth between, depending on who you're presenting to and what you're presenting for. So, yeah, I think really great article. We'll link it below. And if you have if you're a development department person, please get a hold of us. We'd love to have you come on the show and talk about these kind of strategies. But Mark, you have our next article for us.
You bet. This one is from our friends at Nonprofit Hub, called Smoothing Nonprofit Turnover Transitions. And we're not talking the good kind of turnovers like an Apple turnover. We're talking about if you have people.
It's Halloween. We've got to have a pumpkin turnover. What are we doing?
No, if you have people who are leaving your organization, either voluntarily giving you a lot of notice, or maybe quickly, creating a transition plan is going to be really important for your nonprofit business. And so this article kind of talks about how one can deal with that. Some strategies. Again, we'll link the article below, but some strategies for creating this turnover transition plan. Sometimes these turnovers happen unexpectedly, and you have to be able to maintain day-to-day vital operations in your nonprofit. And I think one of the aspects they bring in later in the article that I think is important is, with a nonprofit, oftentimes you have one person wearing many hats. And the smaller your nonprofit, if you have a vital or key person leaving that, then you could be in some serious trouble, right? But by the same token, oftentimes there is some redundancy where a lot of people know how to do the same task. And that seems to be the goal of figuring out, to make people not necessarily replaceable, but to have an idea of what people are doing, so that if something happened, perhaps something catastrophic happens, or there's a death in the family and somebody has to just leave, right? And that can be catastrophic for you, because especially if it's somebody in a key position and, they're in charge of reporting on key government grants or something, you don't want to, or reimbursable grants, for example, you don't want to not be able to get your cash or not be able to continue specific programs because you have had a person kind of turn over. So the idea for them is, the main part is to be proactive, right? Have a plan ready to go. Communicate what your expectations are, and find out from each individual in the organization what exactly a list of their tasks are, right? You usually are going to be working with HR on this process, but they should have a job description. And within their job description, it should list general to specific ideas of exactly what their duties are. And then within the accounting department, you should absolutely have at least one backup person know what those tasks are. If this is a voluntary transition and that person is leaving and giving you a specific amount of time of notice, usually 2 weeks, then you can actually include them in the transitionary process, so that, if you're lucky, you can actually have them train the next person in their position. If you're promoting from within, or if you happen to get a hire that's very quick, then you can actually use the knowledge of the person who's on site. But oftentimes that's not the case. So having people who are backups to specific positions who know what's going on, getting them up to speed in those remaining 2 weeks makes the transition much easier. You want to scope out all of the different principles, guidelines, objectives. It's this one you want the kind of the running of the department to happen before this person gives notice, so that you're not just kind of in a hair on fire kind of situation where everybody's scrambling to figure out what are we going to do now. And then if it's a key position, right, like let's say it's a CFO or somebody who's in a key position, you want to have a true succession plan there, right? Because a CFO eventually will retire. So you want to make sure that there is somebody in the wings who's ready to understand and take over that position, so that the transition happens more smoothly. The different topics that they kind of they have a framework of what you should address in the transition plan. These might include the daily responsibilities, what the ongoing products are, who some of their key contacts are, locations of where the files are. That's super important. Sometimes people, in our technological world, they save things to their local drive and they're not putting them on some sort of shared drive. Boy, I've run into that nightmare scenario before, where you cannot recreate something because it was on somebody's personal laptop that you no longer have access to. Passwords similar, right? Make sure that there is a way in place that you can access passwords to overarching. Obviously, you're not going to maybe have passwords for their individual email, but if they're the only one who holds a banking password, you don't want to be hamstrung for days because you're trying to request a new password there. And then other some less tangible but more fungible components of that, or maybe some checklists of what they do in a day or do in an accounting cycle. Who some of their stakeholders or clients are that you might want an introduction to, and ways to kind of transfer some of their knowledge and skills from one set to another. So I think these are very important things to think about. Sometimes people bury their head in the sand, especially when it's going well, like, oh, everything's going well, I don't have to think about a transition plan. But you never know, and especially in an environment like we're currently in at the time of this recording, where the job market is really favoring the employee right now, right? So there are lots of companies looking for accountants, and they are offering top dollar for some of these positions. And if you're not keeping abreast of what the market is willing to pay, and you're not checking in with your employees to see if they're happy, you might find yourself in one of these surprise situations where notice has been given and you didn't know it was coming, and there's no transition plan in place. So think about it, consider it, and be proactive about it.
Yeah, I think this is something that a lot of nonprofits and probably businesses talk about, putting it down on paper. I mean, if you can just get a daily list of what somebody's doing or policies and procedures in place, I think that's a good starting point. And like Mark talked about, like cross training. I mean, especially in an accounting department, you want people taking time off. You do not want somebody constantly in the same position doing the same job. And in fact, when I was in auditing, that's one of the, kind of like warning signs that there's some kind of tomfoolery going around, is that somebody is unwilling or never takes a vacation. And so having that cross training where if they say they win the lottery and go to Aruba, you're able to at least slot somebody in and have them cross trained to be able to take up that slack. The other thing is, and this goes for almost every business that I've ever worked with, or any nonprofit that I've ever worked with, none of them really have a succession plan. I can remember at the CPA firm I worked for, the office manager who did everything. She kept the books of the firm. She, helped with scheduling. She helped with payroll. She was a really vital part of the office. She was retiring, and everybody knew she was retiring for years. Her husband was already retired. She was at the age where she wanted to retire, and she was ready to retire. And nobody made a succession plan, and it was very difficult losing her. And in fact, the last day she was there, they were sitting with the managing partner trying to go through the folder that she had put together of what she does page by page to understand what she was doing. And it took, I'll be honest, it took years and about 4 or 5 cobbled together admin staff to be able to replace what she did. And so having a plan like this and having a runway to be able to implement it is vital. But too often people look at it as a very daunting task and a very kind of something that's very much put on the back burner. That I think it needs to be looked at sooner in businesses. And oftentimes the person in the position that's leaving probably should be the cheerleader behind this, but often if they're leaving, they don't have the motivation to do so. I mean, you think of like an owner or somebody that's been at a company or a nonprofit for a long time. What's their motivation to do this? Of course, they want to see the business succeed, but they're counting down the days, or they're moving towards this end of cycle being at the business or nonprofit. I think it can be really hamstringing to a nonprofit into, I'll use another personal example. I work with a current nonprofit. They had a bookkeeper that I worked with for 12 plus years. She left, gave a month and a half notice to retire, and they had all that time to kind of absorb her institutional knowledge, have it written down, give her extra time and support to be able to get all that information. They didn't do it. And now they're really scrambling. It's been like 6 months and they're still behind in trying to get somebody trained up in her position, understand what she did and understand the ramifications of her leaving. And they still haven't fully recovered from it. So and they're spending a lot of money to try and, stop the bleeding here. So realize that, like, although it may be more time and effort to do this ahead of time, it's really, really, really important to do this before you come up against it, because it will be a cash suck to your nonprofit or business. I mean, to try and put somebody in a position that is left, that is new, and you're figuring it all. You don't want to reinvent the wheel every time somebody leaves. And that's often what happens. So I think starting with, the policies and procedures and writing down the steps on how they're doing and having an idea of what they do on a day-to-day basis. But then they list kind of the other things like open or ongoing projects, or what they're working towards, because often if you're leaving, you're not putting in extra hours to get these, wants of programs or wants of the accounting department or wants of the nonprofit forwarded. You're just doing the day-to-day to keep what you've done in the past going. So I think, having that passwords Mark mentioned, I mean, banking is notoriously difficult to get, entry into, even as a read-only kind of thing. You can be waiting weeks for a login, or even months for a login, because of all the fintech requirements that are needed for somebody to have access, to make sure they're a real person, driver's license, social security number. You got to give all that information, have a current signer on there just to be able to access the bank account information. So I think it's really important. And then, just having a longer runway, realizing that this is super important piece of the transition piece, if somebody's leaving. So.
Yeah, AJ. And I think the other thing, obviously, to kind of double underline what you said, it's not just a cash suck, it's a time suck, right? Because your example where they're not even caught up after 6 months, right? There are other things your accounting department wanted to do with that time, other programs they wanted to implement, maybe a new software piece that they wanted to try out, some other bigger project, that now all their time is being spent kind of playing catch up with what they should have done while the person was still there. And as we were talking about this, it kind of made me think about, right, data backup plans, right? We have and we hear constantly from IT, you need to have a backup, you need to have an offsite backup, you need to have, local files preserved, because nobody wants to lose their computer data, because it's vital, right? But we don't necessarily think about having human capital backup, right? Knowing what the backup for the individuals are. And I think that needs to be as important as the data backup, because, the morbid thought is, if somebody got hit by a bus tomorrow, what would your organization do, right? So make sure you're having that human capital backup plan in place as well. AJ, I think we got a topic for the week.
Yeah, so we had a question come in, and it's an interesting one, one that made me kind of scratch my head, but I think we both have probably something to say about this. So there's a donor that wants to anonymously gift a timeshare. So the question is, wondering if anybody's ever dealt with accepting a donated timeshare and your experience holding it, and if it's a good idea for the charity to enter into that type of transaction. I think it's probably more commonplace, or like maybe somebody else in the community has received like a piece of property, or even like we used to see a lot of car donations for auctions and stuff, and other pieces of tangible assets. But timeshares are kind of different, right? You don't own the building, you just own access to it for a certain amount during the year. And there's a lot of other things that go into it, and depending on what type of nonprofit you are, this could be, and hopefully I'm not stealing Mark's thunder here, but this could be considered unrelated business income if you're.
You bit alert, you bit.
Woo, 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 woo. Red lights everywhere. But yeah. So I'll let Mark kind of speak on this, but I thought it was an interesting question, and one that I have not heard before: a donation of a timeshare, and what the complications and kind of like nuances of that consist of.
Yeah, I think this UBIT, I think, was one of the pieces I was going to bring into play here. And unrelated business income, for those who may not have heard us talk about this ad nauseum on other podcasts, is basically you bringing in some sort of money into your organization that isn't specifically related to your mission, right? That isn't part of your, let's say, 501c3, if that is your nonprofit designation, right? So if I'm thinking of like, if you have a parking garage attached to your nonprofit and you charge rent for that parking garage is not, part of your mission, but you're bringing in cash for that. So you're going to have to pay some unrelated business income tax on that. And that's where a nonprofit becomes taxable, or one of the ways. So similarly, in a timeshare situation, if you're not housing foster kids or paying for short-term housing where you could use this timeshare, you're really looking at unrelated business income. And I doubt by the HOA rules you could actually house people temporarily in a timeshare in any case. Timeshares, right, they're notoriously finicky, right, about what you can do with them. So the other piece of this puzzle that I would say is, you're going to have to figure out some way to manage this, right? Because if you're renting it out and collecting the income off of that, or if you're donating it, or what you're doing with it, it's going to have to be managed. So, we don't particularly ever want to turn down a donation, but this would be a case where, similar to stock sales, I would recommend that you graciously accept the timeshare donation with no strings attached, knowing that you could turn around and sell this timeshare and get the cash and be out of it, right? Because having a timeshare is something that somebody's going to have to manage, and it's going to cause you a tax headache in the future. So again, I don't know all the particulars of this. And I don't know if the person who's donating it says, well, I don't want you to give away the timeshare. I want it to be perpetual income. But you as an organization can say, yeah, we don't do that. We don't have the staff to manage that kind of thing. So I guess my advice is just say no.
I'm in the same boat, man. I would be like, run as far away from this as you can. I mean, let's be honest, like the way people get into these timeshares is they're usually, a free vacation or something, and you're set in a room with a high pressure salesman, to get this free trip, and you lock in, and now you're paying maintenance fees and whatever it costs you to get into this stupid thing. And, like, you haven't used it in 2 years, and I just want to get out of this. And selling them are a real nightmare. So if you're a nonprofit thinking about getting into this, selling them can be it's almost like pennies on the dollar just to relieve somebody of a timeshare. And the other part, as a donor, you have to be able to make this, even have a chance of this donation being tax deductible, you have to have a fair market value, an appraisal of some kind that you can show the IRS if they ever come a knocking on what this thing was worth when you gave it over to the nonprofit. And so that the nonprofit has an idea of how this like-kind exchange, or not like-kind exchange, but this donation that's coming in. What is this even worth? How do we even sell this? What is it going to be worth our time and effort to try and unload this thing? There's not like, Mark brought up stock donations. There's an active market, like the stock exchange, that you can sell these things.
Same thing with car donations, right? You got a Kelley Blue Book price that you can kind of give somebody an idea of what their thing is worth. And I guarantee you, when people are taking car donations, they're not keeping those cars. They don't have a garage full of old cars. They're selling that right away.
Right. Yeah. Or it's a donation, like it's an auction item. So, I think often as nonprofit, we'll take anything. We'll take donations of in-kind donations, like stock donations, or these new charitable giving donations, the donor advised funds. Like there's a lot of avenues for donations these days. Amazon Smile, that kind of thing. Round up to the nearest dollar when you're checking out at your local grocery mart that goes to different charities. But this one is one that I think, like the risk far outweighs the reward in this case. Timeshares are just, there's not an active trading market for it. So it's very hard to unload. Just getting a professional timeshare appraisal might wipe out the donation cost altogether. Then yeah, I just see a lot more problems than it would help.
Yeah, I think the only thing that we've talked about on this podcast that's maybe riskier are NFTs. Oh, shots fired.
And you know what we say about NFTs? No effing thanks. So, but yeah, art. So yeah, right click and save as, like your digital art piece is now worthless in my Twitter.
That's your digital nightmare.
Yeah. Anyway.
All right. Well, I think we beat this one to death, but thank you for writing in, and thank you again to all of our listeners out there for joining us on another episode of the Profitless on Purpose podcast. We certainly enjoy that you're here, and we welcome you to engage with us either by putting comments on YouTube, sending us a tweet at ProfitlessPod on Twitter, and we love to engage with the community. So on behalf of AJ and myself, thanks so much, and we'll see you next time.
Thanks, everybody.